Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about SOFI Technologies SOFI stock by talking about how SOFI Technologies could have a fantastic rebound here in the next 3 months. We're also going to be going over the latest news updates and the newest price targets among professionals, on top of seeing where the stock price could go in the future based on its current growth trajectory. We're also going to talk about Bed Bath & Beyond stock because there has been a lot of news updates surrounding this stock, and I'm going to determine whether or not I'm comfortable or not buying this company. So we are going to be going over and analyzing this stock as well as some of the fundamentals of this overall company. We also have a very strange news update for this particular company because recently there has been insider trading lawsuits as well as the CFO of the company kicking the bucket. So more on that news later. And then lastly, we're going to talk about AMC stock as well as APE stock to determine and go over my thoughts about this company, what I think of APE stock and AMC as a whole. So if you want more stock news videos, remember to go and smash that like button right now, comment your thoughts down below, subscribe if you are new, don't forget to become a member of the channel by clicking that join button right next to the subscribe button so you can be notified on the latest stocks that I am personally adding to my portfolio, on top of the stocks that I think can 10x soon, and whether I think people should buy real estate at this time, as well as some penny stocks and more risky investments that could potentially surge. So if you want more of that type of content, don't forget to smash the like button, become a member of the channel, and without further ado, let's jump right into today's stories. If you didn't know, SOFI Technologies is a fintech company or a financial technology company that operates as a digital bank. They offer their consumers an all-in-one inclusive digital app that gives them access to various financial products and financial services. The goal of SOFI is to disrupt the traditional banking institutions by offering a digitalized version of an entire bank. This is very similar to what Ally Bank is doing, and so far Ally Bank has been a fantastic investment for me personally. SOFI's share price right now currently trades at $5.74, which we actually predicted in a previous video how the stock price was going to cool off and pull back after the student loan moratorium ending date was released by the Biden administration. However, professionals believe the company could surge anywhere between $7 and $11 over the next 12 months. But beyond that, where do we see the stock price heading, and is this still a good investment for investors? Well, as I said earlier, the student loan debt relief plan by the Biden administration has come clean, so we know that there's no longer uncertainty regarding when the student loan moratorium ends or regarding the student debt relief plan. And this originally made the SOFI stock price surge on this news. However, recently the fintech firm's stock price and share price has pulled back recently, just like we predicted in one of our last videos. Now, many investors believe that SOFI Technologies has bottomed out, and I believe SOFI Technologies is going to bottom out at around $5 per share, with SOFI Technologies potentially hitting a near-term bottom. That doesn't necessarily mean that it's time to buy the SOFI stock right now, according to this author. Now, this author, I would say, has a very bearish tint to his analysis, but I do think investors should be aware of the other side. His main thesis is that based on macroeconomic uncertainties and negativity in the overall market, that is going to continuously weigh down on SOFI Technologies because they are a technology growth stock. And during times of market uncertainty, stocks that are trading at a very high premium, particularly growth stocks, are going to be hit very hard. So this share pullback in the SOFI stock price could just be the beginning, because when the overall stock market continues to sell off, that's going to include SOFI Technologies. So why is the overall market potentially going to sell off again? Well, to no one's surprise, it's going to be due to the Federal Reserve increasing interest rates to curb inflation. And I think the Federal Reserve is actually doing a good job about this because they can't press too hard, otherwise it risks the chances of the economy going into a very negative recession, in which a recession could very negatively affect various portfolios, particularly if you have growth stocks or speculative investments in your portfolios. Now, on the other side, we have many investors as well as experts that anticipate that SOFI Technologies and the overall economy will actually recover ultimately, which could send the SOFI share price all the way up to $10 to $15 per share. However, the main reason that this article's author is very bearish and negative about SOFI is because he thinks that their lack of earnings does not justify a $10 to $15 share price. Now, first I want to hold him up right there. There are actually three different ways of looking at this. We have some projections that believe that SOFI Technologies will become a a profitable company on a GAAP basis in 2023. We have other analysts and professionals, as well as stock experts and company experts in this particular industry, that believe that SOFI Technologies will achieve GAAP profitability in 2024, and this author takes the more bearish negative approach that believes they are going to become profitable in 2025 on a GAAP basis. Now, I personally side with the 2024 projections and estimates. However, I just want you to be aware of this, because if this author is right and we take the forward multiple of another fintech like PayPal, which is currently around 23.6 times, that would put SOFI Technologies' valuation at a fair value price of $6.60. However, because this is a growth stock, we are actually willing to pay more for the company now at a premium based upon the future stock price. So $6.60 should be the minimum price target by the time 2025 comes around, even from the most bearish and negative perspective. However, I personally don't believe that. I think this company is most likely going to double before we get to the year of 2025, which means that investors are going to double their money at minimum, in my opinion, in a very short amount of time. But the points that he emphasizes are very good points. The SOFI stock price does definitely depend on their profitability and how soon they can achieve that, as well as the overall macroeconomic factors, because higher interest rates and a negative macroeconomic environment is going to be very bad for growth stocks. Now let's move on to another company and stock that's been in the news quite a lot recently, so I decided to give my opinion on this company after studying it, and that is Bed Bath & Beyond, ticker symbol BBBY. So is this a good growth stock rally, at least for a long-term or even a short-term investment? Well, let's dive into this company. Bed Bath & Beyond, if you didn't know, is a retail company, and the stock price has surged by around 300% due to a short squeeze over the last month. But why should investors not even touch this company with a 10-foot pole? Well, now let's dive into the details. Right now, the current BBBY stock price of Bed Bath & Beyond stock is $8.63 per share. However, stock experts and professionals believe the company could go all the way down to $2 per share, and even on the most positive side, experts think that the company should not be worth more than $9 per share. And spoiler alert, I believe that this company is going to continuously fall in their stock price, and I think that for investors who got to profit from the short squeeze should get out and liquidate their positions with their profit intact. However, that is just my personal opinion. Always make sure to do your own research and follow what you think is the best, because again, this is not financial advice, this is just my opinion. Bed Bath & Beyond right now is in major distress because they are currently trying to fight off bankruptcy, if you didn't know. So clearly this is not a fundamentally solid company. The company has around $1.3 billion worth of long-term debt, and again, that's going to be very bad, especially during a rising interest rate environment, or if we go on to a really negative recession where consumers are going to be less likely to spend money over on a lot of different retail businesses. Also, I want to point out that the company burned around $722 million of cash over the last year, so right now they are treading water, trying not to drown in this current macroeconomic environment, which is very negative. To offset these various risks and to prevent bankruptcy, the company has been downsizing to where it has unloaded around a third of its brands, they've closed around 150 stores, and it cut its workforce by 20% to not go out of business. However, bankruptcy is literally on the doorstep of this company, which means that this company is in survival mode, and in my personal opinion, it is just not worth the risk of an investment right now. Now, for the investors, like I said earlier, that treated this like a short-term position and they used the short squeeze to trade off of this company, I would say well done. Just make sure that you liquidate your position so you can get out with your profits intact. You don't want to be too greedy, otherwise it could be detrimental to you over the long term. So I do not think that this is a long-term company to invest into, and for those of you who played it and traded it, and you did this successfully, then I would say well done. Now, the company is even in deeper water recently because one of Bed Bath & Beyond's executives kicked the bucket, and that would be their CFO, their Chief Financial Officer. And this happened for two main reasons. Because let me tell you, he did not kick the bucket on accident. The first reason for this is that Bed Bath & Beyond is a company who is struggling financially, which puts uber pressure on the CFO, who is the Chief Financial Officer. Now, how he kicked the bucket is interesting. Apparently, he jumped or fell from a $57 57-story skyscraper. And there is a lot of speculation. Some people think that he did this purposefully, and other people think he may have been pushed or potentially coerced into doing something like this. Now, the Bed Bath & Beyond's board chairwoman actually had a lot of good things to say about the CFO, and I'm not going to read this verbatim, but if you want more information, remember to go and check the sources out in the description so you can read these articles for yourself, because remember, I analyze these articles and I give you the best juicy bits of information, but if you want more information, always feel free to read these articles for yourself. The majority of news outlets believe that he himself jumped from the 57-story skyscraper because of economic turmoil and what was going on internally within the company, especially because the stock price cratered 40% after it surged over 300% during the same month. Now, this is where the story gets quite interesting, is because he was apparently in cahoots with a billionaire named Ryan Cohen, who took a very large stake in the struggling retailer of Bed Bath & Beyond while the stock price was surging, and this is exactly what the CFO of Bed Bath & Beyond did as well. So why is this interesting? Well, as you can see on screen, the CFO is the picture on the left, and Ryan Cohen, who is the chairman of GameStop, is pictured on the right. So what is the connection between these two? Well, there's actually a lawsuit that claims that the CFO of Bed Bath & Beyond, as well as the chairman of GameStop, collaborated in a pump and dump scheme, meaning they potentially led to the surge in the BBBY stock price and invested into the company to artificially cause the stock price to surge so both of these individuals could make millions and millions of dollars. Now, this is not speculation because we know that they made a lot of money from this. How do we know? Well, according to the Securities and Exchange Commission filing, they confirmed that Cohen sold his entire stake in Bed Bath & Beyond, which made him profit around $58 million according to MarketWatch. On the other hand, the CFO of Bed Bath & Beyond sold around 55,013 shares during the time of the short squeeze, according to Reuters, and that, based off of the SEC filings, we can say that he made around $1.4 million. Now, in his defense, I would like to say that unlike the chairman of GameStop, the CFO did not liquidate his entire position. He still had around 255,400 shares remaining in the company. However, overall, I am not shocked that there was insider trading, or maybe potential insider trading during this time. But either way, it does not reflect very positively on either of these individuals, especially considering the very strange circumstances of the CFO either jumping or potentially being coerced into kicking the bucket. So this definitely goes much deeper, but I don't want to dwell too much on this. I can only wish the best for the CFO, Bed Bath & Beyond, and the CFO's family. Now, lastly, we're going to talk about AMC and APE stock. Right now, the APE stock trades for $4.97, which was given out as a type of dividend for AMC shareholders, and AMC stock, or their share price, currently trades at $8.80, while many experts believe the company is either worth $1, while many other very apish bullish investors believe the company is worth around $35 per share. So AMC Entertainment, ticker symbol AMC, and AMC's preferred equity, ticker name APE, ticker symbol APE, have both rallied recently and then slightly pulled back. So what are we talking about here? Recently, the AMC stock as well as the APE stock has been very volatile, where APE rallied more than 24% recently based off of the National Cinema Day, which was on September 3rd, where you could go and buy tickets for as little as $3. APE shares were given to AMC shareholders as somewhat of a dividend. However, I really don't like APE stock or AMC because AMC fundamentally is just not a solid company, and APE stock is not very beneficial for investors, but it's extremely beneficial for the board of AMC because they could use APE stock to raise capital and in certain ways dilute shareholders. So I really don't like it. Now, I don't want to go into too much detail about how that works. I'm just going to give you stuff to think about. So overall, I don't think that APE stock is very good for AMC, and similarly to Bed Bath & Beyond, AMC is a struggling company that received a massive short squeeze, and I think it has hurt a a plethora of various investors, to where I would think that a lot of investors need to cut their losses, use their losses as a tax write-off in the form of tax loss harvesting. But all you need to know is APE stock is not beneficial for AMC shareholders or APE shareholders, and this is clearly in the board of directors' prerogative, because they can use this to raise money and even dilute shareholders without having a shareholder vote on whether or not to issue more shares. So overall, I don't think this is a good company fundamentally, and I am not personally invested into either of these companies. I am also not invested into Bed Bath & Beyond, and I have around a 4 to 5% allocation toward SOFI Technologies. But if you disagree, or even if you do agree, go and comment down below your thoughts, subscribe if you are new, and I will see you in the next YT video.